So when looking at some of the funnies coming into our income from farming operations, let's come and have a look at the top of page number 2 again, when we're looking at our flow that we're going to follow. And there's just a couple that I want to point out to you here. Ladies and gents, there are 3 things that happen. So I want you to imagine, let's imagine we're talking about a farmer who farms certain produce, potatoes, cabbages, maize, etc., grapes, etc. And let's imagine also we're talking about a farmer who farms livestock. So what are 2 common things that can happen? Well, if you have a look with me, it is very common that a farmer privately consumes for their own consumption, some of their own produce or livestock. Say, for example, I'm a sheep farmer. I might slaughter one of the lambs for my own Christmas dinner. So what happens if a farmer privately, domestically, and by this I mean for themselves and their own family, consumes some of their own produce or livestock? Well, what they are required to do is they are required to add into their income from farming, careful, the cost of that produce or livestock. So what was the actual cost? Now, the other thing that a farmer may do is donate some of their produce or livestock. Now, all this is contained later in your notes in some more detail for you to read up on, but I just want you to be aware, please, that if a farmer donates any of their produce or livestock, then what they have to do, and please be careful of this because it feels a bit mean, they have to put into their income from farming the market value of that produce or livestock they donated. And very importantly, it doesn't matter who they donated it to, whether they gave it to a tax registered charity, etc. In their farming calculation, they have to add back into their income from farming the market value of the produce and the livestock that they have donated. Now, whether or not they can later claim a deduction against their taxable income under Section 18 capital A will be dependent upon them meeting the consequences or the requirements, should I say, of Section 18A. So when you donate, even out of the goodness of your heart, to any form of charity or anything else, any of your livestock or produce, market value of that must be added into your income from farming. And then a lot of farmers use some of their livestock or produce as actual feeding to their farm employees. So for example, what if I grow a certain amount of potatoes and I use some of those potatoes to feed my farm employees? So ladies and gents, here is where we must be careful. If an employer, the farmer, uses some of his livestock or his produce to feed his farm employees, 2 things happen. Number 1, the market value of what they feed farm employees is added in to income from farming. But, and let me point it out right now, that exact same number that the farmer has to add into his income from farming will be the exact same deduction a farmer is allowed when he claims his general deductions against farming income. But, it is very important in any calculation that the 2 steps are followed. So any of the produce or livestock that is used as rations to feed farm employees, the first thing we do is we take the market value of that livestock or produce and we add it into income from farming. The exact same number we've added in, we then show as a deduction later against our farming income. It's very important that both stages are shown. So let's think about it. What is actually happening here? Well, ladies and gents, remember the deal. You are carrying on farming operations and you're earning income from that. So the Act is going to allow you to deduct certain expenses against your farming income. But if you eat the produce yourself, if you eat the livestock yourself, you and your family, if you donate it away, if you use it as rations to feed your farm employees, then that produce or livestock is no longer available to be sold as in part of your trade. And as such, it's almost like SARS feels it's losing out. So if we have a look at three main issues: donating, add back market value of produce or livestock donated, consume it yourself as the farmer, you and your family, then we add back the cost of the livestock or produce that's been eaten, and rations for farm employees. What do? We first add the market value of the livestock or the produce that is being used to feed farm employees into income from farming, and then claim the exact same amount later as a deduction. So the tax consequence of using your livestock or produce to feed farm employees is nothing, am I right? Because what you put into income, you later claimed as a deduction, but you must show the two steps. It's very important. Now, the other one I want to point out to you, please, are subsidies. Now, ladies and gents, farmers receive different subsidies for different things. They receive subsidies to stop soil erosion. They receive subsidies in respect of helping to remove dangerous plants. They receive subsidies in respect of certain produce and products. So all I want you to know is that if you have a look, you will see the information on page 7 that subsidies received by farmers are fully included in income from farming. And the reason for that is the money received as a subsidy is often used by the farmer to incur certain expenses that are then deductible. So if, for example, I get a subsidy to stop soil erosion on my farm and government gives me a subsidy to do that, I've got to put that subsidy into my income from farming. Why? Because later when I incur expenses stopping soil erosion, I'm going to look to deduct those expenses. Now, we must be careful that very often this causes a cash flow issue for the farmer, because the subsidy must come into income from farming when that subsidy is received by or accrues to the farmer. But it might only be in a later year of assessment that they are going to buy the product, stop the soil erosion, or use the subsidy as intended. So it might only be 2 or 3 years later that they incur the expenses with that subsidy money that they're going to deduct. So just be careful. Now, the one thing I do want to warn you about at the moment is that for many reasons, there's quite a lot of tax information on farmers around that's quite out of date. So in the old days, you used to see that some of the subsidy income that farmers received was tax-free. So if you are reading anything talking about how subsidies are tax-free to farmers, that is old information, and it has been changed. So when you go and have a look on page 7 of this material, you'll see that subsidies are specifically included in income from farming. So that is one of those examples where we've got something we must be careful of. So what are some of the other things I want to just start thinking about at the moment? Well, ladies and gents, recoupments. Because you see, sometimes with farmers, we get so focused on these special first rules that apply to them, we forget that a lot of the normal Income Tax Act applies to them as well. Because remember what we said at the beginning, if we are told to do something in the first schedule, that's it, we must do that. But if the first schedule doesn't deal with something, then we go to the normal parts of the Act. So what we're going to find, for example, is there are certain sections in the Act, like our 11 small e, where we claim wear and tear, like 12 capital B, where we write off certain machinery we use in farming. So ladies and gents, this is where I want you to be careful. If you've got assets that you use in your farming operations that you've claimed normal wear and tear allowances on, if you've got assets in your farming business operations that you've claimed 12B, we're going to look at them, allowances on. What happens if you sell those assets? Well, like any depreciable asset, as we call them for tax, or allowance assets, like any allowance or depreciable asset, if you've got an asset you've been claiming tax allowances on and you then dispose of that asset, depending on how much you dispose of it for, you're going to have to recoup some of those allowances you claimed. Now, a recoupment is an addition into income. So that's exactly what happens to the farmer. Because these assets were used in their farming operations, we claimed normal tax allowances on them, 11E, 12B, but we've disposed of the assets. We have to recoup, add back some of those allowances into the income from farming, and look at any potential remaining taxable capital gain. So you see now, this is where I say to you, we mustn't get so caught up in the special rules for farmers in the first schedule that we forget that the normal tax rules will also apply where appropriate to a farmer. Now, remember I said to you we're going to do this in building blocks, so I'm going to push you a little bit further as well because it's something we have to consider. Remember I said to you, very, very often, we will have, not always, but we will have the farm land that sits in the trust, and the trust owns the land. And then we will have another taxpayer, like an individual, company can also do it, who actually carries on the farming business. They incur the expenses, they run the business, etc. So ladies and gents, here is my individual, for example, who is now carrying on the farming activities. So what have they done? They've bought a tractor, they're claiming tax allowances on it. They've bought seed, fertilizer, they've paid the salaries of the farm employees, blah, 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 right? Because it's in their little individual hands that we are doing this income calculation to see what their taxable income is from farming. Now, let's just start introducing something to us. When the farming operation is carried on by an individual, it will be a very likely reality that at some stage that individual will pass away. So what I want to do is just start us thinking a little bit about that.